Hello, everyone. I'm Roy Zimmerhansl. I'm your host, and welcome to another Securities Lending Saturday. So today, we're going to be talking about CSDR, the Central Securities Depositories Regulation. The penalty aspect of that for settlement failures went live on February 1st. So today, in response to questions from all kinds of viewers about CSDR, the penalties, the buy-ins, and the impact on securities lending, I'm bringing this show to you to talk about exactly those issues. So if you're part of the securities lending ecosystem, if you're a lender, a borrower, an intermediary of some sort, a fintech provider or other service provider, or you're just plain interested, then this is the place for you. So let's get to it. Hi, everyone. As I said, we're going to be talking about CSDR today. I always have my slide deck. Okay, this is what we've been talking about, CSDR and securities lending today. The previous 35 weeks, we've talked about a very wide range of topics, really going from very basics to some very complex areas. So well done to those of you that have watched many, most, or even all of the videos so far. You'll have hopefully got a really huge and broad understanding of the business, which is hard to get anywhere else, except my training courses, of course, where you can always get those. Next week, I'm going to take a bit of a chance, and I'm just going to do a live Q&A. So I don't really have a topic planned for. I welcome you and anyone you want to invite in. If you come in and we do some live chat, we'll actually see if there's any questions that I can actually answer live for you on air and go from there. So it might be the shortest show I've done, or it might be the longest show I've done. Time will tell. So anyway, you've got a week to put together your questions to come on live, ask me those questions, and we will get to it. That's what we're doing next, and we'll see how that actually goes. Okay, today, part 36, CSDR. We're going to look at the background, the penalties and buy-in, a little bit of irony that I see in the whole situation, and then how you can mitigate penalties. As I said, the reality is that this show will be edited, so I'll take out all the rough bits, or as many as I can. Although sometimes it's hard to take out all the rough bits because I wouldn't really have much of a show left. But once the edited video is ready, which will be tomorrow, Sunday at 3 p.m. UK time, you'll see the full edited video and the full show at my YouTube channel, which is right here. And again, if you want to download the slides from this one, I don't know why I say download the slides. You can't download the slides. You can have the slides sent to you. That's even easier. You don't even have to download it. You just have to sign up, and we will send the slides to you in the coming days, not just from this show, but from every one of the 35 that we've done previously, plus today is 36. Let me just clear that out and go to this. See what that bottom line says. This episode and all my other episodes, they're really for only informational and entertainment purposes. They may or may not be entertaining. Not everyone likes dad jokes, and not everything I say is funny, even if I think it is. But look, never do anything on securities lending or indeed anything in financial markets without taking expert advice. This is no different. I have a pretty good handle on what I'm talking about, but you need to identify what's right for you in your own individual circumstances. Of course, I can help you with that as well. So this is what we'll be talking about today. And remember, if you like this show, if you like previous shows, if it gets value for you, then please consider giving me a thumbs up or a like or whatever it is on the platform you're watching it on. And if you want to see future ones or be advised of them, first of all, hit subscribe and then hit the bell. Then my real target right now is to get to 500 subscribers, because then we can open up the community channel and ask questions and share information on an ongoing basis in one place. You can see the videos, you can join the community, you can ask information, ask questions, you can answer questions, you can share information. That's what I'm trying to get to. We've had a good week for new subscribers. I think I had 18 new subscribers this past week. That's probably my best week ever. Don't laugh. 18 is a very good number, and I'm very happy with that. And I'm now 28 short of the 500 target. So I think it's within striking distance. It would be awesome if we could get to 500 in the next week to then celebrate with the live show. Because as I've said, when I get to 500, I'll also be doing some of my course free giveaways. So some of the paid courses, I'll be giving a few lucky people the opportunity to take that course and learn even more about securities lending. Okay, that's the subscribe button. Let's start with the background to CSD. The regulation itself came into effect in 2014, and it has multiple phases and multiple aspects to it, of which the current penalty regime is only part of it. So let's look at some of these things. As I said, it came in 2014. One of the issues which happened a few years ago, which was shortening settlement timeframes to T+2, which went surprisingly smoothly. I think people were well prepared for that. I think that the shift wasn't as complicated because of that preparation and the technology that was applied to it. So I think all in all, that was a pretty big success. Shorter timeframes, of course, reduce risk. Argue, which I might, let me just touch on it now. There's a lot of desire now and impetus to try and get to T+1. So trade today, settle tomorrow, T+1. And there's a lot of value because, of course, it reduces risk because the potential for your counterparty to go out of business between today and tomorrow is less than today and 2 days from now. All right. And so the volatility and the price movement of the securities does also impact them. And many things are solved if you go shorter. And I think that will throw up some very big technical challenges because we live in a global world where asset managers, execution, settlement, currency movements, they all have an impact on efficient market settlements. And if you make it too short, number one, it doesn't give you time to resolve problems because people may be in different time zones. And number two, in most jurisdictions in cash markets, there's the ability to offset transactions. And so if I have a buy and a sell and my buy costs me 100 and my sell generates 100 for me, there might actually be zero cash movement. But if I all of a sudden am making that time frame shorter and I have fewer transactions there, the netting opportunities might actually be reduced. So that's just one example of it. But if you go too short, I think you introduce complexity from time frame, time zone, currency, and problem resolution issues. And if you go to T0, you're basically giving yourself no opportunity to fix things. So I think a number of things would have to change to get to that kind of an environment. And I think that's a long way away. So shorter settlement dates are valuable, but only to an extent. Now, the key thing that we're talking about here is the settlement discipline measures. So the two aspects that they've been talking about are three aspects. First of all, settlement fail. That's important to advise what the fail activity is because regulators don't always know. They suspect that there's regulatory or that there's a bigger proportion of fails than people disclose or they're aware of or they can discover. And so a big part of this exercise has been to get a mandatory regime where people have to report or depositories have to report failed activity so that regulators can monitor the potential risk that's building up in the system. So that's the first part of it. Then the next phase of it was inserting penalties for transactions that didn't settle on time to whoever the failing party is, irrespective of the reason. And then the follow on for that was also buy-ins. Now, buy-ins are a feature of many equity markets. Buy-ins are a feature of most bilateral contractual agreements. But you also have option buy-ins. So someone has to take the action to buy in something in some cases, or in other markets, in some stock exchanges, buy-ins are mandatory. Of course, in those markets, you have fewer fails, but arguably, I would say they have less trading activity because of the mandatory buy-in regimes, because it's too expensive to trade if something goes wrong. And in real life, things go wrong. Right? Buy-ins do exist. Sometimes they're mandatory, sometimes they're optional. And I guess regulators looked at it and said the optional aspect to it very seldom, in fact, ever gets executed. And so it isn't, while it's there as a mechanism, it doesn't necessarily solve it. I'll come back to a few other issues on settlement discipline in a bit. There was other aspects to CSDR. One is an obligation regarding dematerialization of most securities. So right now, people would say it's already electronic. And so the answer to that is yes, they are, but usually they are still held, but they're immobilized. So they're not dematerialized. They still exist in a physical form somewhere. They just don't move around like in the old days when I started in the business. Okay. And so there is an objective or a desire under CSDR to get to dematerialization for most securities. Now, the other aspect is this point about CSDs might operate differently in different markets. And what the regulation wants to happen is for all the depositories to have similar prudential limits and controls in the way they do the business, so that there's less variability between markets there, so that it's continuous and consistent throughout Europe. Again, limitations on who can access depositories, and that's always been a feature of the market. And the whole idea is that this is one continuous ecosystem. So whether it's banking or depositories or market participants, they're all linked to each other, and a problem is one is likely to generate a problem. Let me just clear that one out. The bottom line here is, of course, of all of these regulations, the idea is the EU wants to have increased safety in the markets, increased efficiency, and really this specific aspect of it is to reduce fails and thereby reducing risk in the system. So that's the background to CSDR. Started in 2014, still being rolled out. We're a little bit behind already because of COVID. The definition, as it says here, is the non-occurrence of settlement or partial settlement of a securities transaction on the intended settlement date due to a lack of securities or cash, and regardless of the underlying cause. These penalties will apply no matter what the reason is. And one of the issues, of course, is that if there's a fail that I have because someone else has failed to deliver to me because there's a problem somewhere else, they don't care that I say it's not my fault. They want to make certain that I get penalized, and if I have a problem on my end with my counterparty, that's for me to sort out, not the regulators. So look, this is a pretty all-encompassing definition and impacts everyone. Okay, now let's talk more specifically about who does it apply to. That was supposed to happen automatically. Now, originally, this was supposed to envisage both failed trade penalties and buy-ins. So the idea was one of the problems you find, particularly in fixed income markets, where I said equity markets, a number of equity markets have automatic buy-ins, and those that don't have automatic buy-ins do have backup or optional buy-in regimes. For OTC markets, particularly for fixed income markets, there is no exchange. So there is nowhere to actually implement a mandatory buy-in. And as I said before, the optional buy-in type of arrangements that agree in many OTC contracts is not really effectively exercised because people are worried about damaging relationships and the impact that has. So the idea was originally that since many of these securities will settle in the depositories in Europe, the local central securities depositories, or Euroclear, Clearstream, the two international central securities depositories, ICSDs, that they would become the enforcers of buy-ins. And so the original projected date for all of this was September 2020. Apparently something was going on in the world in September of 2020. And so it was delayed until February 2021. And then it was subsequently further delayed until February 2022, which is where we find ourselves today. Now, the buy-ins have been controversial all the way along. Market participants have said that there are already these existing regimes as one point. They've said that this has the potential, buy-ins have the potential to scare away those participants like institutional investors that lend securities. If they ever get bought in, then even if they can pass on the cost to someone else, the hassle of it and the reputation damage of it would mean that they could easily opt out of participation of an optional activity. They don't need to lend securities. Banks, settlement agents, they may need to borrow securities, but if there's no one there to lend it to them, that's obviously a problem. And so there has been a lot of pushback. And in fact, the market has, I think in this case, quite rightly argued that potentially buy-ins would have made the markets less liquid and therefore introducing increased risk to the system. Now, finally in November of 2021, after a huge amount of lobbying, discussion, debate, engagement, the EU agreed to defer the buy-ins indefinitely, right? So there is no sort of target date there. And there is still the potential that they may never actually be applied, but I'll come back to that in a moment. And then the final point, of course, is that penalties have been introduced from the beginning of this month. This is recorded in the middle of February 2022. So penalties are now part of our life for the affected sectors. So the affected sectors, if we actually look at it now, penalties, right? So what does it cover? First of all, it covers securities traded on an EEA or European Economic Area trading venue or OTC in Europe. So if it's traded here, then or if it's cleared through one of the central counterparties in Europe, then it's also captured. And so it captures activity irrespective of where the counterparties are actually located. And the penalties are calculated daily, they're collected monthly. And what they do is they net out credits and debits. So if someone fails to me and they're penalized and I'm entitled the money, then it gets credited to me. If I'm being charged something and it gets debited, and they can offset. And I've heard a lot of talk about people saying that when they were doing their analysis and they were doing their modeling, they looked at this and they said it'll probably net down to zero. And frankly, I hate that. I hate that because what that actually means is we're going to continue to be lazy on the fails that we have going out because we know we got money coming in on the fails to us. And so to me, it doesn't solve the problem. It's an avoidance. And it reminded me of when I first came to the UK in 87, there was a guy who, for one of my clients, which is a firm that, exists in a different form today, but at the time it was Kleinwort Benson. And the guy's name was Tommy Thompson. His first name wasn't actually Tommy. I can't remember what his first name was, but he said to me, he said, Roy, we need help being able to borrow securities to cover our fails. Now, my bank that I was working at, we were doing the clearing and settlement and custody for them. And he asked me to set up a trading desk to borrow securities to make certain that they could cover the fails. And I said, what level do you want me to cover it? At what economic price? And he said, I don't care. What I want to have is a perfect settlement record. And that kind of approach, just personal self discipline and striving for excellence, I found that really inspiring. And so you can see 35 years later, I'm still talking about it. And that has really disappeared over time as markets become larger, more complex, higher volumes and all of that, that kind of has gone away. I'll come back to that in a minute. But that's what ideally regulators want. They want no fails in the system. And from a risk management point of view, of course, you wouldn't want any failed trades in the market. And so it's a laudable goal from that perspective. And if people aren't going to strive for it themselves, it looks like regulators have decided that they're going to help prod them along the way to get there. The areas that it covers is the EU, Iceland, Liechtenstein, and Norway. So that's where it is. This shows you what the rates are. So the rates depend really on the type of security. So is it a stock or a bond? Is it a liquid stock? Is it a less liquid stock? And really, it's that kind of a focus. And of course, the value of the security itself, because it's all basis points rated. So you can see the charges go from 0.1 of a basis point to 1 full basis point for equities that are actually on liquid markets. And by the way, as I've written here, I hate the European Union version and definition of what a liquid security is. There's many different ways to challenge their definition of liquid, and I personally don't agree. But nevertheless, they didn't ask me to write the rules, so whatever I think doesn't matter. Okay, so those are the rates. You can look that up, but you can find them anywhere. I'll post some links to things in the show notes. So if you want to actually go to directly to these things, you'll be able to do that with the edited version when it's ready. Okay. Now, ironic, the history of securities lending really is largely fail coverage related. And that's really how it started. Of course, there's always been short sellers for the past sort of 400 plus years, but realistically, the vast majority of activity, particularly when I joined and in the 70s, before I was part of the business, it was really fail coverage related. And it was really in the 80s and then 90s and subsequently that proprietary trading and hedge fund activity grew so dramatically and really drove the size, scale, and professionalism of the business. But look, the regulators, as I said, felt that settlement discipline needed a boost, and this was their solution. If you incentivize people economically, the odds are that they will act appropriately in line with what you're hoping that they would do. Now, I also get a lot of questions saying, oh, these CSDR penalties may result in more lending activity. And while some people will say there'll be less activity, I'm firmly in the camp that says there'll be more borrowing and lending activity. And so that's obviously a positive. The negative, of course, is that that doesn't mean that it's profitable. There might be more volume. There might even be more revenues, but the net profitability, I would argue, is actually going to go down because the truth is most of these short-term fail-related transactions will be low. They'll be short duration, 1 day, 2 days, 3 days, and that's good. That's what regulators want. They only want to help resolve these short-term fail problems. But look, settlement charges and then the monitoring and maintenance, collateral movement, just all of the administrative costs in securities lending mean that if I was an economically focused lender, I wouldn't do any more trades because I don't see how, no matter what I charge, I can cover that. Now, again, some of these things are actually smoothed out in the ICSDs that have automated lending programs within their businesses. I think in those cases, then it is a better net solution. But in the day to day flow of activity, particularly with equities, I don't see that profitability will be going up, even if revenues do. Now, one of the main reasons, particularly with fixed income securities, that fails have gone up is that in the old days, when we had real interest rates, if a counterparty failed to you, you would make an interest claim on that. And because interest rates were relatively high, certainly high compared to where they are now, it would hurt financially. So people had more focus on settling trades. Now we have these penalties coming in here because of settlement disciplines falling off and because interest rates are so low. And they're coming just at a time as interest rates are starting to go up. Right. So this is the problem with regulation. It takes such a long time to actually roll out. Regulations almost always are solving yesterday's problem, not today's issue. So I would argue that the penalties and or the rising interest rates themselves will address the fails issue that the regulators want to be done, which is good. That's what it's supposed to achieve. And hopefully what that means then is if settlement rates increase dramatically, that maybe there will never be a need for buy-ins to be enacted. And I think that would probably be the best outcome from everyone's point of view. How do you mitigate any of the penalties? Of course, you want to manage your inventory and cash ladders. There's two real different ways that trades can fail. One is I haven't got the securities to deliver. The other is I haven't got the cash to pay for it. If you're managing your cash ladders and your inventory ladders correctly, and you're looking at your trade flows, then you'll be able to see whether you have a shortfall and try to remedy it beforehand. Of course, you want to automate everything that you can so that you can get the reporting and the information and match or pre-match transactions, which gives you a better chance to. Interestingly, one of the issues people have to deal with is the whole securities lending activity. So there's no point lending a security if you've also got a transaction in that. And so I might have a good trade that actually matches, but I haven't got the securities because they're on loan. Of course, you need to make certain that that process is integrated and that you can identify that something's on loan, get it back in time. Or if it's not on loan, the other way around, where you've actually got it out as collateral somewhere else, that you can get it back in time for collateral. So automation to me is the critical point. To me, as I've said, and this also goes back to the last point about profitability for increased securities lending activity, The truth is the post-trade cost infrastructure that we have in this marketplace is still too expensive. It needs to be reduced dramatically, in my opinion, and that should very much be the focus, in which case you end up with a better market. Generating more revenues will generate more profits, and that would be a good thing. And of course, more activity would mean fewer fails, and that's what regulators want. So manage your ladders better. That should give you insight into any borrowing that you need to do, whether that's cash or securities, so you can cover the potential fails. So again, ignore the cost if you're a borrower, because you still have these reputational issues that you want to deal with. And this next point is on partial settlement. I don't know that people really appreciate the impact of partial settlements. So what's a partial settlement? I'm supposed to deliver you 100 shares. I only have 50 shares because someone still owes me 50 and it hasn't been returned to me, or I can't get it back in time for whatever reason. I could agree to settle 50 of those shares with you so that the net exposure is only 50 shares, not 100. That's good from a risk management point of view, from a market perspective. It's good from my point of view because I only have half the penalty or potential penalty there. It's good from my counterparty's perspective because they've got at least some of the position that I owe them. So from a risk management point of view, it's good. But what people fail to realize is that actually the markets are so well connected that even mobilizing a partial settlement will actually grease the wheels to a wider array of transactions. So let me give you an example. A few years ago, when I was still in Hong Kong, we had a client who sold a security, but the amount that they sold was equivalent to 1 month's trading volume, okay, in a single day, in a single transaction. And we had the securities on loan. Now, the normal process when that happens is we look to see whether any other client has those securities, and we would basically replace the existing lending client's assets. So we just rebook the loan and then move the securities from that client's account that has them to the client's account that has loaned them out. And so it's an internal movement. Of course, in this instance, it was a fairly liquid stock. And so we couldn't do that. We didn't have any other clients. We saw in the marketplace, there was hardly anything there. And we had a couple of frantic days on the telephone to everyone we could possibly talk to or know. The borrowers that we recalled on it, they couldn't borrow it anywhere else either. So they were scrambling around themselves. Now, in the end, there were no buy-ins. And that's because through everything that we did, we managed to scrape up about 10% of the needed traded position. Okay. So let's say there was 100 shares out on loan that we needed to get back because the client had sold 100 shares. We got 10 shares back, some from counterparties, some from friends in the market. It all started moving. And those 10 shares settled multiple trades, which then settled other trades, which then enabled us to, us or our counterparties to actually borrow the shares again, cover those positions, deliver to us the next 10 and next 10 and next 10. And because of the multiple settlement cycles of the depository, it kept getting recycled and we didn't miss any settlement date. There was no late failure. There was no penalties, no buy-ins, and it was an automatic buy-in market. So my example is that partial trades really help smooth the marketplace. Now, the problem always with a client is that clients, of course, only want their agents to act on their instructions. So in that example, the client said, I sold 100 shares. So get me my 100 shares and then deliver them to who I sold them to. And we come in and we go, actually, you know what, we've got 10 shares. We'd like to deliver the 10 shares to the counterparty that you sold to. And they go, we don't care. I mean, well, yeah, but we can't deliver 10 shares when you instructed us 100 shares. So you need to give us a revised instruction for 10 shares. And then subsequently another 10 and another 10, another 10. And frankly, they didn't want it. It was a little bit of a contentious issue, to be honest with you. But we ended up getting there in the end. They revised their instructions to us. But look, these are the nuances, and I completely get why they didn't want to do it. It was extra work for them. Now, arguably, they were getting paid for it. Their argument was, we're actually just an investment manager for another beneficial owner. So in fact, we're not getting paid for it. It's just work for us. It might benefit but doesn't do anything for us. I didn't really like that argument so much because we were both working for the betterment of the same underlying client, but everyone's entitled to their own view. So partial settlement to me is the greatest opportunity to smooth things out, but also one of the biggest challenge. And of course, as always, we're trying to encourage people that understand and accept and feel comfortable with the risk profile of securities lending to participate in the marketplace. So we want to encourage lending activity. And remember always that prevention is better than cure. So try to resolve issues so that they don't become potential fails or become actual fails by managing things better on the front end. Okay. So let's just summarize all of this. CSDR, the objective is to make safer, more efficient markets. I think that the penalty regime is likely to do that. The penalties are live now. The buy-ins are to be determined whether they get implemented, and if ever, and let's hope that the markets get improved to a sufficient level where regulators don't believe that it's necessary anymore, but time will tell. The irony is that this sort of penalty regime and potential buy-in regime has been needed more over recent years as the disciplines have economically driven disciplines have fallen off. Yet the years that it was most needed, I would argue the need for that will decrease in the coming years just naturally. And had they done nothing, would have solved themselves, although they couldn't have been predicting when interest rates go up, and that's not the job of the regulators. So I accept that comment. Nevertheless, I think it's ironic. And then finally, prevention is better than cure. So sort your operational processes out, focus on solving the issues. And I think it's been a huge amount of focus on this by firms really in the last year, maybe not before that. And of course, automation for me is almost always part of the solution. That's it. And apparently that's it for the slides as well. We're supposed to have another slide there, and I'm not sure what's happened to it. But it's another one of those vagaries of, do you like my background screen? How's that? Let's go back to me then. So look, that's it for this week. As I said, next week we'll be doing a live Q&A. So if you want to be on a live Q&A and ask questions or share your views on a particular topic, you're more than welcome. So that is the goal for next week. As I said, could be the shortest show ever that I've done, or it could be the longest one. Hopefully it'll be one of the most informative, but that's up to you to ask your questions. So that's it for me. Thanks very much to everyone that was watching this week. I think that's it. Have a great Saturday. Have a great weekend. Enjoy the Super Bowl if you're in for that one. I'm not certain. My head says one team and my heart says the other, so I'm not sure who to go with, but I'm hoping for a great game. Don't try and get in contact with me Monday. I'll be around the rest of the week. Have a great week. Hope to see you next Saturday for the live Q&A session on securities lending, where you can ask me anything. Goodbye.